Now we've come to the process of determining the character of recognized gains or losses. Are they ordinary? Are they capital? Or are they subject to any special tax rates? You may recall from our discussion in Module 1 that business properties are not capital assets because they are depreciable assets used in a business. Therefore, they would not normally qualify for capital gain treatment. As such, the sale or disposition of business assets would be subject to the highest ordinary tax rates. During most of the last century, Congress repeatedly changed how the sale of business properties were taxed because of perceived or unanticipated abuses, excessive tax advantages, and even severe tax treatment. Congress finally decided that such assets deserved limited capital gain type treatment and enacted section adjustments for that purpose. Let me remind you that personal property and personal use property are two different things. Personal property refers to business property that is tangible and not real estate. Personal use property is non-business property. A computer would be personal property if it were owned and used by the business, but personal use property if it were used at home by your family. In Module 1, we spent quite a bit of time learning about the various IRS property codes used to describe the treatment of gains on the sale of business assets. To ensure that this is clear, let me just review these for a moment. There's a lengthy discussion in your workbook. Much of it is similar to what you learned earlier. Here is a brief refresher of each of these categories that describe how a gain is treated for tax purposes. Section 1231 property is personal property and real estate used in a trade or business held more than 1 year. Section 1245 property includes depreciable, tangible personal property such as machinery or your computer. Section 1250 property is real property held long-term that is not and never has been Section 1245 property. Office buildings and rental homes are good examples. Under IRS rules, when Section 1245 property is disposed of, it will yield a gain or a loss. The gain is ordinary income to the extent of prior depreciation allowed or allowable, called depreciation recapture. Section 1250 property gain is treated the same as if it were capital gain and therefore receives preferential tax rate treatment. At the risk of oversimplifying a complicated topic, let me describe it this way. Imagine that a couple of years ago, you purchased a company semi-truck for $250,000. Since that time, you've depreciated $100,000, giving it an adjusted basis of $150,000. If you were to sell it for less than $150,000, you would have a Section 1231 loss, which would be treated as an ordinary loss. If you were to sell it for over $250,000, you would have a 1231 gain, which receives capital gains treatment. Whenever you sell a business asset, whether it be a personal asset or real estate, for more than its adjusted basis, which is the amount of original basis after deducting depreciation, you will also have depreciation recapture. In the case of personal assets, that gain, up to the amount of the depreciation, is considered a 1245 gain and is treated as ordinary income. So if we were to sell this business truck for $160,000, we would have $10,000 in 1245 gain. If instead of a truck, this example was for real estate, you would have 1250 gain and the gain would receive capital gains treatment. The sale or disposal of business property is reported on Form 4797. Some of these amounts then carry forward to Schedule D, where you can match the gain or loss with other gains or losses. As a reminder, losses on the sale or disposal of personal use property are not deductible. However, profits from personal use property are taxable. In those rare cases where this happens, these profits are reported on Schedule D. Let me give you an example. If you purchase a vehicle for yourself for $15,000 and later sell it for $5,000, you cannot deduct the $10,000 that you lost. However, if you purchased a car for $15,000 and then it became a high demand car and you later sold it for $25,000, the $10,000 gain would be reported on Schedule D. Obviously, if you owned it for over a year, it would be a long-term capital gain. Up to this point, we've discussed what happens when business property is sold, disposed of, or traded in a non-taxable exchange. We talked about calculating basis in various situations, calculating gain or loss, and the circumstances under which gain is recognized. In the next few sessions, we're going to begin working with the individual business forms.